Hey everyone, James Anadon here with Pillar 6 Advisors. Today is Friday, March 5th, 2021, and this is our March market outlook. More from a fundamental basis. I know I've covered a couple technical analysis over the last couple weeks, and I will reference those here in this video, but right now it's more about the fundamental side of it. Over the last 2 weeks or so, we've definitely had a pullback in the markets. It's well known. Some areas are hit harder than others. And we'll go ahead and take a look at what we're seeing and why that is. Some of it is more knee-jerk reaction. Some of it may be a shift and change into a different direction. So the first thing that we need to look at, and I've mentioned in the past technical analysis videos, was the 10-year Treasury yield. And not just the 10-year Treasury, but how it's started to climb and at a much faster rate than typical, and how that can affect stocks. And we spoke about that 2 weeks ago. We spoke about that a week ago as well, and I showed those charts again. But from our perspective, what we need to look at here are a couple important things. What caused the spike in 10-year Treasury yields, right? And so the first thing there is it's definitely investors who are moving away from bonds. They're selling bonds and moving into assets that are more inflationary protected. So things like commodities, energy, some metals, not necessarily precious metals right now, because gold and things like that have they have an opposite move to the 10-year yield. But, those are some areas, and those are real assets in a way. And so essentially what that is if you come to an environment of inflation, those assets are the ones that tend to gain. Now, I do believe that the move in the 10-year is a bit knee-jerk. It's a bit exacerbated. And I also believe that the federal government right now does need to step in. They will step in. The last thing that they need right now is another asset price correction of epic proportions like we saw coming into COVID here. There's some big underlying changes underneath, and they want to continue that moving forward. They want to spur the growth of the economy. They want that shift to happen, and the Fed has come out to say that they will be accommodative for that. And so that's a very, very important thing to remember. Just because the market's had a swift correction here, especially in some assets like technology and things like that, doesn't mean that the bull market's over. We're kind of might be moving into a different perspective here from an investor's forethought. As things start to open up, it seems like investors believe that as vaccines are going to be administered a bit more quickly than anticipated as well, at that point things will open up quickly. People are getting stir crazy and they're ready to go travel, which means leisure is going to have an uptick, which means money is going to move into the economy a bit more. We might start seeing a little bit more of a money velocity pickup. And those are very, very important things. That is yet to be seen, but what the market likes to do is it likes to put its money and bet on things that are roughly 6 to 12 months out. And it looks like we're starting to see that shift. That's a really good sign. You can tell that if you look at Dolly, you can see what assets are moving to that green side, which are kind of the stronger assets. You have energy up there. You have consumer cyclical, which, remember, consumer cyclical is all about consumer spending. So if the market believes that consumer spending is going to rise, consumer cyclical will do well. And then we're also in an environment where, the average investor believes inflation's coming. Some even believe hyperinflation's coming. That remains to be seen at this point. Inflation at this point looks like it's been pretty tempered, but that's what this month is all about, actually. We're about to see a year-over-year inflationary expectation from last March, which, as you remember, was basically the bottom of the coronavirus sell-off, right? And then we're here this March now, and there's a lot of data that's going to be compared. A couple things of note is we need to pay attention to continuing claims for unemployment as well as new claims for unemployment. And then another one to look at for us here is going to be retail sales. And so, that goes along with that consumer cyclical as well. Another thing to remember that may be important is the stimulus bill. That's already been priced into the market. The market believes that's coming. The only difference that may happen is it may be smaller. than what was anticipated, or it may actually work some things in there that might not have been anticipated. But either way, it's a good thing. This is what the government needs to do right now. I mean, we're still looking at 10 million people unemployed. The economy is moving forward. The market's going to invest in what it believes is going to be moving forward here in the next 6 to 12 months, as I've mentioned, and I've mentioned that in the past. The market is a pricing mechanism for stocks into the future, right? Based off of earnings. Where are earnings going to go? A dollar is going to flow to where it believes it's going to be treated best. And that's what's happening. Now, is that going to continue and become the new theme? It's absolutely possible. That shift from growth to value seems to have been kind of the play over the last month or so. That is still yet to be seen. Now, we need to pay attention to that. And that's what Dolly helps us do, and that helps us shift. I believe over the next couple weeks, the largest thing that we'll start to see is the Fed coming in and managing the long end of the yield curve a bit. I know there's been a lot of money moving out of the Treasury market into, as I mentioned, commodities and a few other assets, and that's really what's pushed the 10-year Treasury higher, but also brought down bond prices, right? And so bonds are starting to look a little bit attractive here. If if we're sitting on cash and you want to allocate to bonds, that could happen. Which, by the way, I'm not recommending anything here to buy or sell. That's not the point. The point of it is just to give an overall basis of what we see happening. And from that, it's a good segue to go ahead and let's move into Dolly. I've covered it in the last video, but I want to cover it again and just show you exactly where we see ourselves right now. This is Dolly, our dynamic asset level investing tool. There's some explanation right here to help you out. If you have any questions on it, feel free to reach out to us. I can give you some more information. But essentially what this does is this ranks asset classes, sub-asset classes, and then as well sectors, which are right here. These are sub-asset classes and these are asset classes. Against each other, and tells you which ones are moving stronger versus one another. And so right now, small cap growth is still in the first place. Small cap blend has actually moved up slightly faster than small cap value, which in the last video, small cap value was moving pretty quickly here. Mid cap growth was overtaken by small cap value. That's pretty important to remember, as small cap tends to perform fairly well as the economy would start to get going. Again, energy right here is in the top spot. Consumer cyclical second to that. Technology lost its spot here. It's still holding strong in the third spot, so that's a very interesting scenario. Of course, when energy does well, as well as the 10-year Treasury or any treasuries are spiking higher, financials are going to do well as well. So we need to watch that relationship. But right now, energy is in the top spot, consumer cyclical second. And by the way, consumer cyclical are those companies who are going to benefit from money moving more freely in the economy. Those are going to be our leisure stocks, travel companies, things like that. And that's about it for our March outlook. I hope this video was helpful. Of course, there's big changes going on, and our plan is to keep you abreast of the situation. If you're a client, we appreciate everything from you guys. We appreciate all the trust you give us. And if you're not a client and you find some information in here that you have questions about and want to learn more about our strategy, please feel free to reach out to us. We're more than happy to help. And give you some more information about what we're seeing and how our process works. And of course, if you're a client, feel free to reach out to us anytime. More than happy to go over your portfolio with you and just give you some of our thought processes and what we see happening in the market. Until then, thank you so much for your time. Have a great day.